Welcome to today's explainer. I'm absolutely thrilled to be walking you through this topic because honestly, we're tackling one of the most fundamental dilemmas every single investor eventually faces. Look, if you've spent any time looking at portfolio construction, you already know the classic tug of war. On one side, you have stocks, the engine of growth, driving your portfolio's appreciation over time. And on the other side, you have bonds, the anchor of income, providing steady payouts to help you weather the storms. But choosing between stocks growth and bond income, well, that can often feel like a really frustrating compromise. So let's dive right into this, because this question right here is basically the holy grail of investing. Stocks for growth, bonds for income, but what about both? Is it actually possible to find a structural asset class that doesn't force you to choose? To answer that, we really have to look closely at the inherent limitations of that traditional two-part portfolio. Now, according to research from Weiss Ratings, traditional portfolios are split up for a very good reason. You buy stock mutual funds primarily for appreciation. The risk there, of course, is market risk, meaning if the overall market drops, your equity funds generally go down right along with it. Bond funds, on the flip side, are targeted for income through steady coupon payments, but they carry interest rate risk. When interest rates rise, bond prices fall. Historically, these two asset classes have this inverse relationship during market cycles. They balance each other out, which is fantastic for diversification. But it still means your growth engine isn't paying you much income, and your income engine isn't really growing your capital.
So here's our roadmap for this explainer. First, the real asset advantage. Second, introducing the ABLD ETF. Third, the free cash flow formula. Fourth, inside the portfolio. Fifth, performance and market standing. And finally, navigating the risks. Let's jump right in. Section 1, the real asset advantage. Bridging the gap.
We need to define exactly what bridges this gap between pure equity growth and fixed income. And the answer really lies in stepping out of the digital realm and into the physical world. FactSet defines real assets as physical or tangible assets with intrinsic value. We're talking about real estate, infrastructure, commodities, and natural resources. Now, why invest in real assets? Because they represent a sort of Goldilocks blend for your portfolio. Think about it. Unlike a tech startup whose value is based purely on future growth projections, a pipeline, a warehouse, or a toll road has inherent physical worth. Because these assets provide absolutely essential services, they generate steady, bond-like cash flows, which are often tied to inflation, by the way, while still being structured as equities that offer stock-like appreciation. It's this tangible foundation that makes this dual mandate actually possible. Moving on to Section 2, introducing the ABLD ETF. Let's look at a real-world case study. Because understanding real assets in theory is one thing, right? But how do you actually access them efficiently in the real world? This brings us to a highly relevant case study operating in the market right now. Check out this timeline for the Abacus FCF Real Assets Leaders ETF. It originally launched way back on December 13, 2021, under the ticker DFRA. But the landscape shifted pretty significantly in late 2024. On December 2nd, Abacus Global Management, which is a major alternative asset manager with nearly $3 billion in assets, completed their acquisition of FCF Advisors. Shortly after that, on December 13th, 2024, the fund was officially rebranded to the ABLD ETF to reflect this massive new powerhouse backing it.
Section 3, the free cash flow formula and their proprietary algorithm.
Now, what's really interesting about this slide is the core philosophy that Abacus brings to the table. They don't just buy any random real asset company. They apply a highly specific proprietary algorithm to filter the market. Their quantitative evaluation basically boils down to a three-factor checklist. Step 1, quality of earnings. Step 2, free cash flow profitability. Step 3, dividend yield. So why does this matter so much for real assets? Well, because physical infrastructure requires massive capital to maintain. A company can show some great accounting profits on paper, but if they aren't generating actual abundant free cash flow, they simply can't maintain their assets or pay you a reliable dividend. This algorithm makes sure the fund is hunting for real cash, not just paper profits.
And let me tell you, they are incredibly strict about this. According to FactSet, once the eligible universe of real estate, infrastructure, and natural resource equities is scored on those three cash flow metrics we just talked about, only the top 25% are even considered for inclusion. No exceptions. By focusing exclusively on the top tier of free cash flow generators, this methodology actively weeds out companies that might be highly leveraged or just flat out struggling to convert their daily operations into actual cash in the bank. Section 4, inside the portfolio. Let's see how they're applying the method. 55. That's the current number of holdings in the ABLD portfolio right now. So we've got the theory, and we've got the quantitative formula, but this is what that methodology actually purchases when it's applied to the open market. The index rules actually state it will select up to 75 stocks, but currently it specifically targets just 55 U.S. real asset companies. That tells us right away that this is a highly concentrated fund. It's not just blindly trying to buy the entire market, it's specifically zeroing in on those high-conviction cash flow leaders. When we pop the hood and look at the top holdings, the whole concept of tangible assets really comes to life. You see MPLX and Plains All American Pipeline. These are massive physical energy, logistics, and infrastructure networks. You have Cheniere Energy Partners, heavily involved in liquefied natural gas terminals. You've got Simon Property Group, which literally owns premier shopping, dining, and mixed-use real estate all across the country. These are companies that own the physical backbone of the economy, and the Abacus formula has flagged them as prime free cash flow generators. Section 5, Performance and Market Standing. Time to analyze the data. 10.96%. That is the fund's average annual total return on net asset value since its inception in December 2021, according to their recent shareholder report. Because look, an elegant formula and physical assets mean very little if they don't actually deliver hard results. For a fund focused on physical assets and income, maintaining double-digit historical annualized growth is a seriously strong testament to the methodology. So, the crucial point is right here, 4.18%. That's the trailing dividend yield noted in the Koala Gains analysis. Remember our original dilemma? Stocks for growth, bonds for income. By generating nearly an 11% annualized return since inception while concurrently offering a 4.18% dividend yield, ABLD is actively attempting to bridge that exact gap we talked about, providing both equity appreciation and substantial income. And the recent momentum has been particularly robust. Looking at a trailing one-year window, the Koala Gains data shows ABLD delivering a 27.72% cumulative price gain. In that exact same time frame, the broader S&P 500 delivered 20.86%. This brilliantly highlights how, in certain economic environments, high-quality real assets can not just keep up with, but actually outpace broader market equities. But to be completely objective, we have to look at the full picture provided by independent analysts. The Koala Gains report gives ABLD a slightly mixed overall profile. On the positive side, they highlight the fund's 100% positive calendar year hit rate since inception and its solid role as a downside buffer. However, they also point out that an expense ratio of 0.39% is somewhat steep for a passive index tracker. Additionally, while the absolute returns are solid, the fund's standing among its peers has been kind of volatile, swinging from the first percentile back in 2022 down to the 95th percentile in 2024. Section 6. Navigating the risks. Let's look at the objective realities. Let's move to our final section and see how this all builds together. Obviously, no investment is without trade-offs, and it is absolutely vital to understand the objective realities and inherent risks of investing in real assets. Both the fund's prospectus and market guides from platforms like Kraken highlight specific risks. Because ABLD invests heavily in real estate investment trusts, or REITs, it's fully exposed to things like tenant defaults and fluctuations in underlying property values. Furthermore, real assets are highly sensitive to interest rates. When rates rise, the cost of financing those huge infrastructure projects increases, which can really pressure profit margins. And just like all equities, these stocks are subject to general market volatility and potential liquidity constraints. Which brings us to the absolute golden rule of investing, perfectly summarized here by Kraken. Putting all your money into a single type of investment is risky. Spreading your money across different investments makes you less dependent on any one to do well. Real assets, even ones with exceptional free cash flow, are not a silver bullet. They are a highly effective piece of the puzzle, designed to provide a very specific blend of yield and growth, but they should never, ever be the entire board. And this brilliantly illustrates the core takeaway of today's explainer. We started out with that tension between stock growth and bond income. We've seen exactly how tangible assets, when evaluated through the super strict lens of free cash flow, can offer a really compelling middle path. So I'm going to leave you with this to ponder. In a world increasingly dominated by paper assets, digital valuations, and crazy market volatility, is your portfolio grounded in enough reality?